Welcome to Cross-Border Tax Talks, where we discuss the latest trends in international taxation, from UK tax reforms to the OECD's latest developments. I'm Doug McHoney, PwC's International Tax Services Global Leader. Check out PwC's Policy on Demand news platform that provides in-depth insights and analysis on tax policy developments. Policy on Demand is now available for free at policyondemand.pwc.com. On this week's episode of Cross-Border Tax Talks, we're at PwC's EMEA International Tax and Legal Academy in Madrid, Spain, where I'm excited to have Matt Ryan back for his third appearance on the podcast. Matt is a London-based international tax partner and the leader of PwC UK's Pillar 2 Ready teams. Matt, welcome back to the podcast.
Thanks, Doug. It's great to be back here in Spain, actually. The last one was in Spain. We'll have to do the next one in the UK.
I agree. I do think it's a little odd that we've had the last two podcasts have been here in Spain talking about UK tax, but a lot of things to talk about here from a Pillar 2 perspective in the UK.
Yeah, absolutely.
So Matt, the last time you joined this podcast, you gave us a schooling on the UK parliamentary process, and I will admit I'm being a bit generous with that characterization.
I think so. I think if we could stick to tax, I'd be much more comfortable.
All right, well,
rather than UK general knowledge.
I'm going to test you again.
Okay, let's try.
So the second draft of the UK legislation was recently released on Pillar 2. How does the legislative process work in the UK, and how and when will the Pillar 2 rules become enacted law?
Okay, well, specific to finance bills, which is closer to home with tax.
All right.
But the process is you have your draft finance bill, the legislation's contained in there. It goes through a number of readings at the UK Parliament. The House of Commons has 2 readings, followed by a committee stage, that's to go through adjustments in the rules, a report stage, and then a final third reading of the bill, at which point in time then it's done and dusted from a House of Commons perspective, and that's the point at which it's substantially enacted, at least from a financial accounting perspective. And then it goes through the House of Lords, where they have that exact same process in the House of Lords. Once it's finished in the House of Lords, to the extent there are no further amendments to be made, generally not in the cases of finance bills, it then requires royal assent to be passed into law, royal assent granted by the King, and I think timing-wise we can expect to have that before Parliament goes into recess at the end of July.
And so where are we today? So it's end of April 2023, we got the second draft. Kind of where are we in that process for Pillar 2?
Oh, you might have got me here. I think we're on the committee process.
Okay.
I think it's had its first 2 readings in Parliament.
Okay. And so we think that it could be substantially enacted as soon as July?
Yes.
Okay.
Yes.
All right, and then we won't test you on some of the accounting implications, because I know there is currently some uncertainty, and we're waiting on comments with respect to IS 12, specifically for IFRS taxpayers. I
can give you a little bit on IS 12.
Okay.
Like, go double check this. Again, I'm not an accounting expert, but yeah, as you say, IS 12, accounting standard for taxes. The proposal on the table is a deferral for deferred tax, mandatory deferral, and then some reporting obligations for companies in relation to Pillar 2. So whilst no need to disclose deferred tax, there will be, or it's proposed there will be, a requirement to separately disclose the Pillar 2 current taxes. And then in relation to the timing of when this becomes relevant, the final report is coming back, I think, in May. But based on the latest meeting, it was the first year end where you will have a formal Pillar 2 reporting requirement would be a 31 December 23 year end. And so it's that point on as companies go through their final year end or their interims when you're in 24 that there will be a Pillar 2 reporting obligation. Obviously, some companies voluntarily disclose forwards their tax rate, and if they're doing that, they'll need to take Pillar 2 into consideration.
Yeah, so that's a little different, I think, from the US GAAP guidance, where similarly period accounting, no deferred taxes, but I think IFRS taxpayers or IFRS filers, I should say, should take note that there may be some disclosure requirements and calculations that are required for 2023, which could be challenging depending on the state of the law and when various jurisdictions implement these rules. So that's I think a perfect transition to let's talk about the UK, kind of where we are from a rules process. And Matt, I've been working very closely with you, and I know many advisors as well as taxpayers are busy building their Pillar 2 calculation engines. And one of the challenges that we have is like, will every jurisdiction follow the model rules exactly and the commentary? And then we've already gotten some guidance which amended the model rules and commentary. We're expecting some additional guidance. Will the UK results for Pillar 2, the final rules, deviate, in your view, from the OECD model rules and commentary?
Well, I'll start off by saying there's no intention that the UK deviates from the model rules, but I think in practice we are going to get a substantial amount of variances. And the reason for that, I think, Doug, you touched on it when you were introing the question, that it's a complex process from a legislative perspective, because we have draft model rules, which you would think you can just transcribe some model rules. But as you say, they weren't completely clear, the model rules. They were clarified and in some instances varied by the commentary. And then we've had the administrative guidance, which has also varied or modified or added in new rules to the whole process, without it being kind of clearly defined rules. So each country needs to take those materials away and draft legislation to enact them. And so the UK has done that. The first draft of the legislation was released last June. We've got the second draft of the legislation released in March. And there are still a significant number of variances between the UK rules and how we would interpret and how we understand the OECD interprets the collective rules, commentary and guidance. And we recently met with HMRC and HM Treasury, and they've clarified that the UK doesn't intend to depart from the model rules. And so what we're just seeing are the difficulties in transposing that overall framework into UK legislation.
Yeah, and so that's why I started with the question of when do we think the UK rules may get enacted or substantially enacted, and you mentioned July. Well, I think that we're waiting for additional administrative guidance, right? So it's very possible that the next round of administrative guidance may answer some of the questions, hopefully all of the questions, although I'm a little skeptical of that. There are a lot of questions that continue to pop up as we continue to see and address different fact patterns. How in the UK does it work if the UK enacts the rules in July and there's additional guidance or subsequent changes, whatever? How does that work in the UK with respect to trying to get those changes incorporated into UK law? And one of the questions that I've gotten a number of times is it possible, for example, for the UK to just make reference to the OECD guidance such that it would then, any future changes could just sort of automatically, if you will, be incorporated into the UK law?
Okay, so the answer to the final question is no, we won't have just a reference to the administrative guidance, often referred to as the ambulatory approach, where it will just get continuously revised as the guidance gets updated. That's not the way that the UK legal process works. It operates off the draft legislation. In certain areas, say transfer pricing, it does reference the OECD, but a static version of the commentary. And so if you need to change the rules by reference to the commentary, we've got precedent where they just go in and they update the guidance they're referring to, and it applies from the point in time at which that subsequent legislation is enacted or a statutory instrument is passed. And so that's how they're dealing with it in the Pillar 2 legislation that we have in the UK. There is authority given by Parliament in the law for statutory instruments to be subsequently released, which either vary the rules or introduce kind of new ones where there's gaps. And so the process in the UK we have is that they apply prospectively, sometimes where there's been changes that are taxpayer friendly, so it's changing the rules so that they are, if you like, in line with the policy and principles of the rules. There's like an unintended consequence of the UK drafting that would result in a taxpayer having incremental tax to pay. In a number of areas of the UK legislation, those changes have been retrospective, but anything that results in additional tax being paid is always applied on a prospective basis. But because Pillar 2 is a global set of rules and the overall aim is for global consistency, the current thinking from the UK is that all changes would apply prospectively.
Yeah, so that is going to be very challenging then for taxpayers. I think that one of the concerns that I had would be that various implementing jurisdictions may either have different interpretations of some of the rules from the model rules commentary as well as the administrative guidance. Some of them may make policy decisions where they can potentially deviate. And I think what we're seeing is that there now may be kind of what I'm referring to as a natural deviation, just depending on what jurisdiction's timing looks like for substantially enacting these rules. And if the administrative guidance comes after that particular time, then we could just have kind of a natural deviation in these rules where the UK is able to incorporate the administrative guidance that's issued before July, but other jurisdictions whose legislative process maybe doesn't go till December will then have those particular rules included. And we could end up with significant deviations across the globe on just because of the timing of the enactment.
Oh, absolutely. I very much expect you're going to have those natural deviations, as you suggest. I mean, the UK, as I said earlier, started really early in the process. We've had draft legislation since last June. As I mentioned, there's still significant differences in it, and other countries are starting later. Europe's a great example where you have the directive that's been passed. The directive's already out of date because the directive was pre the administrative guidance. So when we get the additional administrative guidance, it's going to be like 2 versions out. And I think there'll be a question within Europe as to which countries just enact the directive as required of them versus those who go and incorporate the administrative guidance. So be it as a consequence of proactive decisions that are being made as to which version of the rules you're enacting given your specific legislative process, or that natural deviation just due to the sheer complexity of turning the combined overview of how the rules work into operative law. Yeah, but I think we're going to see different variations in different countries.
Yeah, and I think what that really highlights is for taxpayers and advisors that are building calculation engines, the importance of really having a broad and deep expertise in international taxation across the globe to be able to follow the legislative process, understand where those deviations may be, because they could result in material differences from just using the OECD Model Rules commentary and administrative guidance. So just a big challenge for both taxpayers and advisors as they're starting to think about how do they actually calculate these specific Pillar 2 tax liabilities.
Yeah, and I'd agree. It's critical to have that framework in place to check between the jurisdictions what the differences are and, do it on a very speedy basis.
Okay, so let's go into some of the rules and remind listeners what is the timing of the income inclusion rule, the undertaxed profit rule, and the QDMTT, the qualified domestic minimum top-up tax in the UK.
Okay, so the income inclusion rule and the qualified domestic minimum top-up tax follow the same timetable. That's for periods commencing on or after 1 January 24, so 2024 for IIR and QDMTT, With regards to the Undertaxed Profits Rule, UTPR, the UK has said that the earliest it would implement is accounting periods commencing 1 January 2025. That decision has not been taken yet, so if you like, it's under review.
So one of the things, as I know you're well aware, is that for U.S. taxpayers, we're seeing, despite the fact that the corporate rate is 21%, and then you add state to maybe 24, 25, or something in that neighborhood, that given the incentive regimes in the U.S., particularly with respect to general business credits like the R&D, including our foreign-derived intangible income, then a number of taxpayers are falling below the 15% globe rate in the UK or in the US. What about in the UK? I know you obviously have the qualified refundable tax credit for purposes of R&D. The corporate rate is going up in the UK. Are you seeing many UK taxpayers that could potentially be subject to the QDMTT, or is that more kind of just a protective measure?
We are seeing it in some instances, so notwithstanding the increase to the 25% rate in the UK, where groups are benefiting from the UK patent box and they've got a significant proportion of their profits falling into it, then at a 10% tax rate, that 10% rate isn't moving, even though the headline rate moves to 25%. So that is dragging some companies into having a UK Pillar 2 liability, especially then when you interact that with the way losses work, timing differences, deferred tax assets. So we can see that we're seeing that combination in practice. But the UK is also applying the qualifying domestic minimum top-up tax to UK-only groups. So UK-only groups who meet the 750 million plus threshold are also within the scope of the UK qualifying domestic minimum top-up tax. They're probably a protective measure or one to achieve consistency among taxpayers, so you're not disadvantaging one group over the other.
Yeah, I think that earlier, that first point that you made is pretty common. Like, the stuff just starts to stack up, right? And so maybe you have a big book tax adjustment or a big incentive or whatever that is, then you start stacking up some of the other adjustments that are required to determine your globe income. And I think that there are a number of, and I think it's important for listeners to be aware of, don't be fooled by the statutory rate. It's really important to kind of peel back the onion, understand any incentives that you may be given, and then all of the various adjustments to figure out whether your globe rate may be below 15%.
No, absolutely.
So what about a common question that I get a lot of is tax compliance and filing requirements. Any update on that from a UK perspective?
Yeah, we've got the if you like, the compliance section of the legislation as to who's got to file the forms and when. So the starting position is the ultimate parent entity has the obligation to file the return. Taking your US multinational example, let's use a UK holding company, which will have subsidiaries underneath it, which have a Pillar 2 top-up tax liability. That liability would be collected in the UK company, but it's the US ultimate parent entity that has the filing obligation, with the ability to delegate that filing obligation, if you like, to any other member of the group. It's the same for the qualifying domestic minimum top-up tax. The rule is that it has to be the same entity that files the IR return has the obligation to file the QDMTT return. So your starting position there is that US parent would have the UK QDMTT filing obligation, albeit it's obviously only containing the information relevant to the UK entities. As to exactly what information is required, as I said, the UK is intending to follow the OECD, and so because we don't have the final answer there, we equivalently don't have the final answer in the UK yet either.
Yeah, we're all anxiously waiting to see what that compliance, what that form may look like, and I think we're all hoping it may deviate a little bit from that globe information return, which, as I've stated publicly before, feels more like a list of data points than a tax return.
Absolutely, yeah.
So let's move on to some of the specific, maybe deviations, if you will, whether they're intentional or unintentional. And we obviously don't have time to go through all of some of the minutiae, but really wanted to highlight a few of them that I think could be applicable to a number of taxpayers. Let's start with partnerships. How does the UK legislation, from a Pillar 2 perspective, tax partnerships?
Okay, well, there's consistency between the first draft of the UK rules, the latest draft, and the model rules, where the partnership is the ultimate parent entity, and Pillar 2 tax is levied. Where the partnership is an intermediate parent, under the last draft of the UK rules, there was no collection of tax at the partnership level. So if the partnership was a holding company, you just go down to the next holding company within the rules and apply the income inclusion rules to, if you like, the net below the first holding company within the rules. And the model rules give jurisdictions the option as to which they want to choose. And so if we fast forward now to the current draft of the UK rules, we actually have a difference dependent on what type of partnership you have. Where you have a UK limited liability partnership as an intermediate holding company, it's subject to Pillar 2, regardless of whether the partners are UK residents or non-UK residents. In the case of a non-body corporate partnership, that as I say, you have a different outcome. Where you have UK tax resident partners, Pillar 2 tax is collected and it's paid at the UK resident partners. But where you have non-UK resident partners, no Pillar 2 tax is levied at that level. And so we now have an inconsistency, which is odd from a UK tax perspective, because generally partnerships in whatever form are treated the same from a UK tax perspective. And so we need to see what's going to happen when the legislation gets revised, but my expectation would be that we'll have consistency, and it would be to collect Pillar 2 tax at the partnership level. I'd say the fact that it was revised to collect it in relation to the UK LLPs highlights an intention to collect it at the partnership level, and they'll just need to address it so that all partnerships are subjected to Pillar 2 tax, regardless of who their partners are.
Yeah, partnerships certainly a very common investment vehicle across a number of sectors and industries, and so taxpayers should take note of what type of partnership that they have, because the rules may differ depending on the type of partnership, and then we'll see ultimately where this lands from a UK
Absolutely,
perspective.
yeah. Check what your existing position is today, what type of partnership you have, what the outcome is, and then watch for the revisions to the legislation before it's enacted.
Okay. Let's move on to the country-by-country safe harbor, because that's certainly getting a lot of attention with Pillar 2. What does the most recent draft legislation talk about the C-by-C safe harbors?
Yeah, well, there was what appeared to be a deviation from the UK in its drafting, where the information to do the calculations wasn't actually coming from the CBCR report itself, but the UK legislation referred to the information coming from the underlying accounts used to prepare the CBCR safe harbour, which, dependent on the mechanics of how you do your consolidation and how you pull your CBCR together, could result in a different outcome from the actual numbers in the CBCR report. So discussions with HMRC, HM Treasury, we understood that that's not intentional. And the intentional part of the UK rules is that the report itself, in addition to needing to use qualifying financial statements exactly as the model rules, the actual CBCR report itself needs to be prepared in accordance with the CBCR regulations in ultimate parent entity jurisdiction. So if you like, we've introduced a legislative requirement for that CBCR report to be correct. And if it's not correct, you don't have the ability to use it to benefit from the safe harbour calculations. And what we've seen in practice when we've been doing a lot of our work with taxpayers and looking at their CBCR reports is that actually they're not quite qualifying in a number of instances. The base groups are obviously starting with the rules, but then adjustments are made if the information doesn't quite look right the way they've aggregated it together, either to tie it into the consolidated accounts, which means it's clearly wrong because it's meant to be aggregated information, or where there's a number of prior year adjustments in the actual entity accounts, and because tax authorities generally look to the entity accounts, adjustments have been made to tie the numbers into the entity accounts, not the consolidated accounts, which again would render the CBCR report non-qualifying and you wouldn't be able to benefit from the safe harbours. So lots of work being done scrubbing CBCR reports.
Yeah, and we've mentioned this on prior podcasts, but it's worth highlighting again that I think there's a lot of work that taxpayers need to do. So the experience that you have in the UK is very similar to what we're seeing for US taxpayers, is that we know that, and we'll talk a little bit later in the podcast, that one of the biggest challenges for Pillar 2 is getting the data. And I think that a number of taxpayers had similar issues just getting the data from their systems into the country-by-country reports. And obviously the country-by-country reports before Pillar 2 did not impact taxation. And so maybe did not get quite the scrutiny maybe that it otherwise would have if it would have actually directly impacted the tax liability.
Yeah, absolutely.
And so I think just a lot of work that many taxpayers need to do to determine their processes for the country-by-country reports and making sure that they are qualifying. Do you have any thoughts on how the UK may audit the country-by-country reports or that process, what that might look like?
That's the thinking's developing as to how HMRC are going to audit it in practice. I expect some guidance will be released in relation to this, but given that there is the self-assessment obligation that the return you file is correct in the UK, combined with the fact that your audit firm, if you're wanting to rely on the safe harbours to prove that there's no Pillar 2 tax for reporting purposes, the onus, I think, will be on the taxpayers and the audit firms to be the kind of the first level of defence in terms of the Pillar 2 reports, the CBCR reports being correct.
Right. All right. One of the other questions that we've gotten a lot is prior year adjustments and how that works for purposes of determining the numerator, so your covered taxes for the country-by-country reports. Did the UK discuss that, or some of those uncertainties?
Yeah, no, we had a discussion around that. As I said, the legislation actually said take the numbers from the financial accounts. So there, the financial accounts numbers have both prior year adjustments and current year adjustments just to come up with the one tax number. And the intent was it's that one tax number that they're after. The uncertainty that's driving the questions comes from the model rules and the commentary around that for the CBCR safe harbours, where in part it refers to just the tax number. And so taking the tax number from the account, that would include prior year adjustments. But then you've got the footnote that says, take your CBCR current tax number and add on your deferred tax. But obviously the CBCR number, if the report is correct, should only be the current tax number. And so that was driving the uncertainty. The view was that wasn't intentional. And so, yes, it should just be the combined current year and prior year number to give the overall tax charge per the accounts.
So let's move to deferred taxes. We'll stay in the covered tax. We'll stay in the numerator, if you will, on covered taxes, and wanted to understand the UK's approach, at least in this most recent guidance, with respect to deferred taxes for branches of the UK. It is obviously very common, I mean, probably most common in the financial services industry, oil and gas industry, but certainly not unique to those particular sectors where UK or frankly any multinational will operate in branch form, and branches are very common. What does the UK legislation tell us with respect to specifically deferred taxes and branches?
So the UK legislation does deviate from the model rules and commentary in this instance, or at least how we were, and we and others were interpreting those rules. And the UK draft rules does not allow a push down of deferred tax at the head office level to the branch. And that you've got the same rule actually for CFC. So no push down reallocation of deferred taxes to branches or CFCs. But we understand that this is actually reflecting the current status of discussions at the inclusive framework level. And so this change in the UK rules may well apply across the board as we get the next round of the administrative guidance, which could well incorporate this change as well. And what we're seeing when you say, well, what does this mean in practice that you can't push those deferred taxes down? And it gives rise to another situation where you can have what you would think would be an unintended top-up tax, because if you take the UK as your head office jurisdiction, as we said before, 25% headline rate from April, and you then have a branch in another high tax jurisdiction, you would not expect to have any Pillar 2 top-up tax if you're not benefiting from any incentives.
Right.
If you're just applying the rules, you've got no non-qualifying incentives, one would expect with those two jurisdictions to have no Pillar 2 top-up tax. But because you're not pushing down deferred tax, if you have a loss, say, in year one that creates a deferred tax asset, and that deferred tax asset is utilised in year two to offset the profits of the branch, so you have no current tax at the head office location, but you have a deferred tax charge, that deferred tax charge doesn't get pushed down to the branch, thus generating the top-up tax in what you would envisage is a very high tax situation.
Right. Which seems like an odd result.
Which is an odd result. So if you've got any jurisdiction that taxes branches, you could have this outcome. If you've got a branch exemption, one would think this isn't going to be in point. But absolutely, if you're taxing branches, then there is the chance here that you'll have these mismatches, predominantly with losses. Other deferred tax attributes can create this, but if you've got cyclical businesses, very much like oil and gas and financial services, then this could have a real impact in practice.
Yeah, and I think it's a mixed bag kind of around the globe insofar as what jurisdictions just treat the branch as flow through or what potentially they allow as a branch exemption. So it will be important for taxpayers to understand that. The last one I wanted to highlight was QDMTTs, and specifically whether those qualified domestic minimum top-up taxes may be creditable against a CFC charge in the UK.
So no specific change to our CFC rules to address this, but when I think that the definition of tax within the UK CFC rules is sufficiently broad, being a tax on the profits of the CFC, that it would be creditable. But you could envisage in practice, as QDMTT rules are introduced, that if there's a administrative relieving provision that allows one entity to pay the qualifying domestic minimum top-up tax on behalf of all the entities in that jurisdiction, then that would be a tax that is paid on other companies' profits. And so in that instance, that element of the QDMTT tax of another jurisdiction wouldn't be creditable. But you could envisage this situation if their rules make it the liability of another company, And so you're paying a QDMTT in relation to a CFC of the UK, but a company not under the UK is bearing that tax, then you might not actually get credit for it. So it's something that we'll need to look at in practice once we get each jurisdiction's QDMTT rules and the interaction with CFC rules.
Interesting. All right. Well, I mean, there were a number of different deviations, kind of open-ended questions, uncertainties, but just wanted to highlight a few there, and we'll continue to track that legislative process and look forward to seeing the final rules. I'm really concerned that we're going to end up seeing just a huge slug coming in December.
Yes.
You know, to the extent that jurisdictions will be implementing, like we've already seen Japan, and then hopefully the UK by July, give taxpayers as well as advisors a little bit of time to digest those rules. But and then also, as we mentioned with the timing of the administrative guidance, could be a really kind of interesting 12 or so months.
Oh, yeah, I fully expect we'll get the UK legislation finalised, then likely have some more administrative guidance, and so actually have the statutory instrument process in the UK to come in and revise the rules, and that's built in to apply for a couple of years. So I just think we're going to be in this process as countries just vary their rules over the next couple of years post enactment.
And hopefully they converge at some point, but you can also imagine
that's the goal.
Yeah, you can imagine that certain jurisdictions may make certain policy changes too. I mean, we've really just been focused on just when is the administrative guidance coming out, and assuming that every jurisdiction implements those rules wholesale, which certainly the rules were designed to encourage. But you can imagine certain jurisdictions making policy decisions that could slightly differ, which will make things even more complicated.
Yeah, absolutely.
So as I mentioned, we're recording this in the last half of April of 2023. Matt, where are UK taxpayers generally on their Pillar 2 journey? And it feels like, at least in the US, that there were a small number of taxpayers that spent a lot of time on this, and I think that really in the first quarter there was an awakening period as we think about the stages of grief, maybe an acceptance. But where is the UK generally from your experience?
I think we can pretty much hold up a mirror to your US experience there. So there's a broad spectrum of experience from those groups who've been in the detail for a long time, tracking the rules as they're developed, and have identified where they're going to get all the data points from to run those Pillar 2 calculations. They're in the minority. The majority, as you say, are really embarking on their journey to be Pillar 2 ready. And the key focus at the moment is on where to get that data. So the data grab, the identifying where in their systems they can get the data points from, or the data points that more importantly, don't exist in the systems today, and how they're going to put the process in place to get those data points to be able to run the calculations. That's the key area of focus at the moment.
Yeah, I think that's been the biggest challenge for taxpayers around the globe. And I think one of the things that I've seen is that there were a number of taxpayers that were excited to be able to rely on the country by country safe harbor.
Yeah.
So that you don't have to go through all of the detail, at least to the extent that you can meet the safe harbor rule for those 3 years, to actually do that denominator calculation of globe income. But I think, as we mentioned earlier in the podcast, it's been a surprise that taxpayers still need to do some significant work on the country by country reports from a data perspective to make sure that they're qualifying.
Yeah.
And then it also kind of begs the question of, well, if you're going through that entire process and having to source data for purposes of the country by country report, do you just go ahead and do the detailed globe calculations and put that process in place?
Absolutely. I mean, that makes perfect sense. If you like, why do the exercise twice?
Right.
Because if you've just got one country that doesn't qualify for the safe harbour and you need to get the data points, then you're going to have to talk to all the relevant stakeholders in the organisation, reporting, IT, tax, to get hold of it. So yeah, why not do that exercise once? But the strategy of looking at the CBCR to minimise what you need to do from a reporting perspective is a really good strategy, but you need to run that in conjunction with the data gap analysis. So yeah, you're in a position to go forwards and really minimise the amount of time, which is going to be a considerable amount of time, minimise how much time you're spending at grabbing that data.
So last question then, Matt. What advice do you have for taxpayers here as we're kind of rounding the first quarter and looking at, less than 9 months, less than 8 months to get ready for Pillar 2?
I think the first one is ensure that you've engaged with all the relevant stakeholders. As we just mentioned then, getting hold of the data is going to require a combined effort from the reporting team and the IT team, HR for various data points. It's a big exercise within the group. It shouldn't be shouldered by tax alone, and so requires groups to work collectively. And so ensuring that you're having those conversations with the broader stakeholders, whether you're insourcing, outsourcing, co-sourcing, groups will need incremental budget to deal with Pillar 2, both monetary and resources. So having that conversation early on is key. And then just reinforcing what I mentioned earlier, doing that data gap analysis. The data is at the heart of your Pillar 2 calculations and your Pillar 2 ready strategy. So just determining what data you have, what data you don't have, and in relation to don't have, what's our strategy and process to go forth and collect it.
Well, great advice. So get started, taxpayers, is my advice. So, all right. Well, Matt, thank you very much. We'll continue to follow the UK and look forward to having you back when we get that final legislation here in a few months.
Excellent. Thanks, Doug.
So thanks for tuning in to this week's episode of Cross-Border Tax Talks. Thank you, Matt Ryan, PwC UK International Tax Partner. I'm Doug McHoney, PwC's International Tax Services Global Leader. Stay tuned for another exciting edition of the Cross-Border Tax Talks podcast.
This podcast is brought to you by PwC, all rights reserved. PwC refers to the U.S. member firm or one of its subsidiaries or affiliates and may sometimes refer to the PwC network. Each member firm is a separate legal entity. Please see www.pwc.com/structure for further details. This podcast is for general information purposes only and should not be used as a substitute for consultation with professional advisors.